Welcome to The Deep Dive, the show where we cut through the noise and deliver the critical insights you need to stay well informed.
That's right.
Today, we're diving deep into the recent Q2 2025 earnings call for Kering. You know, the global luxury powerhouse behind iconic brands like Gucci, Saint Laurent, Bottega Veneta.
Yeah, huge name.
And our mission for this deep dive is really to dissect Kering's latest financials, get a handle on their strategic direction, and honestly figure out why the market reacted with such, well, surprising optimism, especially given what looked like a pretty challenging quarter on paper.
It's fascinating, isn't it? That disconnect between the headline numbers and how the market responded. It tells you investors are definitely looking beyond the immediate issues. They're anticipating a significant strategic pivot.
Okay.
So we'll break down those financial results first and then try to connect those numbers to the bigger strategic shifts Kering seems to be making.
All right, let's jump right in. A quick snapshot of those Q2 results. Kering reported revenue of $3.704 billion. Now that number was down and pretty substantially 18% on a reported basis. And 15% on a comparable basis, you know, when you adjust for currency and store changes. And crucially, that actually missed what the market was expecting.
Yeah, a miss there. And looking at profitability, their recurring operating income came in at $969 million.
Okay.
Which translates to a recurring operating margin of 12.8%. That's a big drop, 470 basis points year over year.
Wow.
And for context, remember, a basis point is just 0.01%. So we're talking a 4.7 percentage point decline in their margin.
Right.
That's a clear sign of the pressure they're under profit-wise.
Definitely.
And what's also really important here is how differently their key brands performed. It wasn't uniform at all.
Absolutely. Gucci, their biggest brand, their flagship, saw a huge 25% comparable decline in revenue. I mean, that's a really striking figure for such a major name.
It really is.
Saint Laurent also struggled, down 10%. But interestingly, Bottega Veneta showed some real resilience. They actually managed to increase revenue by 1%.
A bright spot there.
Yeah, and Kering Eyewear, maybe a segment people overlook sometimes, turned out to be a quiet powerhouse. Revenue up 1% to 2%, okay, but its operating income soared by 25%.
Quite the performance.
Right. On the other side, though, their other houses segment that includes brands like Alexander McQueen, Brioni, they reported a 29 million model loss.
So you look at all that, and on the surface, the numbers seem, well, pretty soft, maybe even concerning for a luxury group.
Right.
Yet, and this is the key thing, Kering's shares actually jumped about 5% right after the release.
Yeah.
Which immediately makes you ask, why the optimism? It strongly suggests the market is looking past the immediate pain. They're focusing intently on the company's future strategy, the turnaround prospects.
It's like investors are buying the story, not the current chapter.
Exactly. They're buying into a future narrative, not the present reality.
Okay, so this is where it gets really interesting. Despite these challenging numbers, investors clearly saw something compelling for the future. Let's dig into the why behind that optimism. Maybe start with Kering's financial stewardship, their cost discipline. That seems pretty impressive and, you know, foundational for any turnaround.
Definitely. A key piece. What's fascinating is their free cash flow from operations. It stood at a strong euro 2.4 billion.
That is strong.
It is. But it's worth noting, 1.3 billion of that came from selling real estate. So it shows a very deliberate strategic use of assets to generate cash.
Right. Not purely operational flow.
Exactly. And alongside this, their net financial debt also improved quite a bit. It came in at 9.5 billion at the end of June. That's a 1 billion improvement from the end of last year. Clearly shows a focus on deleveraging, reducing their financial risk.
And they're not just selling things off, they're also tightening the belt on spending, right? Capital expenditures, CapEx, the money spent on, say, new stores or factories. That was 431 million, down a significant 20% year over year if you strip out the real estate part. And for the full year, they're projecting CapEx to be kept around 1 billion. Shows real discipline even while they're trying to reinvent themselves.
Absolutely. And their work on operating expenses, OPEX, the day-to-day running costs is really paying off.
Yeah.
First half group OPEX, down 11% reported. That's over 550 million in savings.
Wow.
And management thinks they can get a mid to high single-digit decline for the whole year. Crucially, they stressed, these are structural, long-term savings. not just one-off cuts.
So sustainable changes?
Sustainable changes, exactly. Done through things like organizational reviews, getting better deals on procurement. It suggests a fundamental shift in how they manage things.
And part of that discipline, which, can be tough, involves headcount reduction. Their overall workforce is down 4% since December 24.
Okay.
And 7% compared to the first half of last year. And if you look just at Gucci, the brand facing the biggest hurdles, it's seen a massive 22% reduction from its peak headcount back in late 2022.
22%.
Mm-hmm.
That's a serious streamlining effort.
Right.
Shows real commitment to efficiency there.
It really does.
Now, on gross margin, they're expecting the second half to be similar to the first.
Yes.
That's actually a change from before when they hoped for improvement. Seems it's mostly down to regional mix, where the sales are coming from.
Got it.
And interestingly, non-recurring items were actually positive, 32 million. Mostly driven by gains from selling assets, like a building in Tokyo, a luxury outlet. And they said more disposals like that are expected. They're clearly optimizing their assets.
Okay, so it's clear Kering is seriously getting its financial house in order. That definitely helps explain some of the market's positive reaction.
Sure.
But that's just one piece, right? The bigger story, maybe the more compelling reason for the optimism, seems to lie in this audacious strategic reinvention and some really big leadership shifts that promise a new direction.
Yeah, CEO François-Henri Pinault himself called the first half a period of momentous decisions.
High stakes.
Very high stakes. And perhaps the biggest decision, the clearest signal of intent, is the new CEO, Luca de Meo. He's set to join officially in mid-September.
Right, the big hire.
Exactly. De Meo, for those who don't know him, has a strong track record turning brands around. Seat, the Volkswagen brand.
Yeah.
He focused on electrification, efficiency. His appointment really suggests a major strategic pivot towards operational excellence, brand revitalization.
So it's still early days for his specific plans.
Very early. Management hinted we might get a comprehensive presentation of his ambitions sometime in 2026. So we have to wait a bit. But it raises the big question. What will his vision mean for Kering's iconic brands, especially Gucci?
Yeah, that's the multi-million euro question, isn't it? Especially for Gucci, which is already undergoing this major creative reboot. Demna is now the creative director. Full collection coming in September. Big fashion show in March.
High anticipation for that.
Definitely. But we're already seeing some early signs. New products like the Giglio bag, the updated Marmont apparently performing strongly, selling out fast in some places. The Mini GG in Asia also launched well.
Okay, some positive signals.
Yeah, the focus seems to be on injecting that elusive quality of desirability, that emotional pull, plus renewed creativity. They're also tackling affordability, expanding price points, and crucially, speeding up time to market for new collections, trying to stay relevant.
And it's not just product, it's the stores too. They're optimizing the store network pretty aggressively. They've actually upped their closure target. It was 50, now it's a net reduction of up to 80 stores for the full year.
80 stores net, that's a lot.
It is. It's a very deliberate strategy. Fewer but higher quality locations, moving from just being everywhere to having a more curated, impactful presence. And this is a multi-year thing, continuing into 2026, 2027.
And Gucci's a big part of that.
Gucci's roughly half of those closures, really emphasizing the brand's effort to refine its physical footprint and elevate its image.
Okay. Another strategic move, maybe a bit counterintuitive, is Kering Eyewear. They're buying Italian manufacturers, Visard and Lenti.
Right, consolidating the supply chain.
Exactly. Vertical integration, bringing production in-house, trying to boost margins in what's been a really resilient segment for them. Those deals should close in Q3.
Smart move to shore up a strong performer. Now, looking at the other brands individually, Bottega Veneta kept impressing, showed resilience.
Yeah, driven by local demand, right. And North America was strong, up 18%.
Huge growth there. But softer tourism did hit them in Western Europe, Japan, the Middle East. Shows how linked they are to global travel. And there's new creative development coming in the fall. First collection from the new designer, Louise, in September. So continued evolution there.
Okay. Saint Laurent. Retail was down 12% comparable in Q2.
Bit weaker there.
Yeah, but interestingly, new products, women's shoes, new handbags, they're actually doing well, suggests a category turnaround is happening. The problem is that strength hasn't quite offset weakness in their carryovers, the classic stuff.
So newness is working, but the core needs a boost.
Exactly. A brand in transition, it seems.
And then the other houses, they face challenges. That 29 million operating loss we mentioned, largely down to Alexander McQueen, which is restructuring.
Okay.
But conversely, Brioni showed positive momentum, driven more by elevated casual wear, not just traditional suits. and strong made-to-measure services, so adapting well. And the jewelry houses, Boucheron, Palmolato, Quaylen, proved pretty resilient. People still buying high-end, timeless pieces.
So pulling back to the bigger picture, what does this all tell us about broader market trends, geography? Retail traffic was weak pretty much everywhere in Q2. Consumers are hesitant.
Yeah, footfall down.
But, and this is a subtle but important point, average unit retail, AUR, the average price paid per item, and the average overall transaction value both increase.
So fewer buyers but bigger spenders.
Precisely. So while volume might be down, those who are buying are spending more per purchase. Provides a bit of a buffer.
That makes sense.
Yeah.
What's really hitting hard, though, is the slowdown in tourism spending in Q2. That directly impacted places like Japan, down a steep 29% comparable.
Wow.
And Asia Pacific, down 19% comparable. Although we did see some sequential improvement in Asia Pac because spending is repatriating locals buying at home instead of abroad.
Okay. North America showed some improvement, down 10% comparable, which is actually 3 points better than Q1.
A slight uptick in confidence there, perhaps linked to the stock market, as luxury spending often tracks perceived wealth.
Right.
China, though, remains complex. Really challenging. The overall economy is weighing on consumer confidence. You see these really high savings rates.
People are cautious.
Very cautious. And more discerning. Prioritizing real quality, higher price points, high jewelry, top-end stuff over more accessible luxury. Kering's still positive on China long term, but management admitted there's uncertainty about when things will really shift back.
And external stuff like tariffs.
The 15% tariff situation is seen as manageable. They made some price adjustments in Q2, might do another round in the autumn.
Okay, so putting it all together, the Kering story is clearly shifting. It's not just about waiting for the luxury cycle to turn up again.
No, definitely not.
It's a narrative of, well, bold strategic reinvention. And the market's positive reaction really shows a belief in this structural reset. It's a bet on the strategy, not the current numbers.
Exactly. And key catalysts to watch now. Luca de Meo's integration, obviously. Then Gucci's new creative direction, the presentation in September, the big show in March. Those will be critical signals.
Yeah, huge moments for the brand's perception.
And the Kering Eyewear acquisitions closing in Q3. That should further stabilize that segment.
So investor conviction is going to hinge on seeing continued cost cuts, signs of stabilization at Gucci retail, and, broader consumer recovery, especially in Asia and North America.
It's a mix of internal execution and external market help, essentially.
Right.
And the current valuation, the derated multiple on Kering stock, some see that as a real opportunity.
Meaning it's cheap relative to its potential.
Relatively cheap, yeah. It implies the market is willing to look past the current weakness towards that potential long-term value, believing that new leadership, creative relaunches, cost control can reignite the underlying brand power, which is still there despite the headwinds.
Okay, so having dissected the strategy, the numbers, the market view, let's shift gears a bit. Let's do a thought experiment. If we take this forward-looking optimism, this bet on the turnaround, and push it to its logical, maybe aggressive investment conclusion, how might someone play this? And remember, this is purely for exploration, for entertainment, definitely not financial advice.
Okay, let's brainstorm. The big idea we could explore is going long Kering, but using long-dated, out-of-the-money call options.
Right. The setup is perfect for this kind of thinking. Kering posts a really tough quarter, especially Gucci. Stock goes up 5%. Why?
Because the market's looking ahead. Discounting the present pain, betting on the reset, pricing in future optimism already.
So, the aggressive pitch. Go long Kering, but with serious conviction, serious leverage. Buy out-of-money calls strike price higher than the current stock price expiring way out, say, early 2027.
Yeah, give it time to work.
Exactly. The rationale is you're betting fully on that multi-year turnaround. De Meo's arrival, Demna at Gucci, the store rationalization, the deleveraging. These aren't quick fixes.
Nope. Foundational shifts.
Foundational shifts. And luxury desirability, that it factor, it often lags reality. It takes time to rebuild that consumer connection. But by 2027, if these moves pay off, Kering could see a significant re-rating, brand power restored, efficiencies kicking in. Those calls give you time for the story to play out.
Okay, but let's talk about the outrageous part of this. Yeah. You're buying calls on a company whose numbers are still, frankly, painful.
Right.
In a luxury market that's softening, you're betting heavily on management executing perfectly, and on that elusive desirability returning years from now. It's high conviction, high leverage, on a future that's absolutely not guaranteed. You're accepting potential short-term pain.
Totally. Paying a premium now for potential exponential upside later.
The plausible part. The market itself is already signaling this forward look.
Yeah.
If that strategic blueprint does translate into renewed brand heat, better financials, those calls could deliver massive returns as the stock recovers from its big multi-year slide.
Yeah.
It's not about playing today's fundamentals. It's about playing the narrative shift, getting in on the turnaround story before it's obvious to everyone. It takes vision and patience.
A fascinating, if risky, thought experiment.
Absolutely. So to recap this whole discussion, Kering's Q2 call showed real challenges, especially at Gucci. No doubt about it. But management's decisive actions, new leadership, creative changes, aggressive cost cuts, debt reduction, they're clearly resonating. Investors seem willing to look past the immediate weakness.
Yeah, this deep dive really highlighted that Kering is deep in a profound strategic reinvention, trying to position itself for long-term value in a really dynamic luxury market. And that tension, that interplay between the current financials and the market's optimism about the future, that's what makes the Kering story so compelling right now.
It really is. And as always, please remember the insights we share here are just for informational purposes. They should definitely not be considered financial advice.
Absolutely. We encourage you, though, to think about how companies in your own portfolio might be navigating strategic shifts during tough times. It's a great lesson in how markets can price in future potential, not just current struggles. Thanks for joining us.
We'll catch you on this call.